Welcome to Markets Now. I'm Michelle Rook along with Martinson of Martinson Ag on what is a mostly lower day here in grain and livestock futures trade, and not unexpected as we go into the Fed announcement this afternoon. Randy, that's really key here, isn't it?
It is. I mean, we've been leading up to this, everybody, with the low unemployment numbers, with the, inflation numbers continuing to stay fairly strong. Everybody was expecting that the Fed would be forced to increase rates a half a point today. Of course, with the banking troubles that came into play here a couple of weeks ago, now everybody's kind of backpedaling a little bit. But, the Fed really doesn't or shouldn't be looking at, those kind of problems to make their decisions. I still expect that we're going to see a pretty good hike in the interest rates just so we can try to get a little bit of a handle on this inflation.
So the Fed fund rate is betting on a quarter. If we go to 50 points, if the Fed just decides we're going to rip the Band-Aid off, talk about what you expect for market reaction and what does that signal by the Fed?
Well, that signals that the Fed is trying to get things in line, and they're not going to let outside forces dictate, their decision. Their focus is trying to get the economy settled down, and their way to do that is to make the interest rate adjustment. So they're taking their job seriously to try to do what they have to do to control the economy. What it would do is it would send the stock markets, I think, sharply lower. It would send our meats, I think, we'd see some sell off in the meat markets as well. And I think the grains would see some, residual spillover pressure as well. They would recover probably quicker, but it's going to be a while. I think that it'd take a while for the stock market and the meats to see some recovery with this kind of news.
We have a quarter point basically already factored in here. So if we get that, then probably we'll see some calming down here of some of the nerves that we've seen with the risk off, or not.
I think we would. I mean, if it's only a quarter point, I think that will bring in a little bit of stability into the markets. We won't see, I mean, the dollar, I think, will then start to see a little bit of a retracement again. Gold will slow down its run. We won't be seeing the safe haven runs. And I think it'll help bring some stability into the cattle markets again, too, and help try to prop that market back up again as we continue to see extremely tight supplies.
So the risk off with the banking situation and even prior to that has been reflected here in the Commitment of Traders report. We finally got up to date yesterday, and boy, the short position as far as the funds in the corn market is really increased, hasn't it?
It has, and I think Chicago wheat too has seen a big increase in the short position. So yeah, we've been seeing quite a load going that direction. We kind of expected that we would start to see that, especially with the slow demand in corn and with the wheat situation. Soybeans, on the other hand, we're still seeing a little bit of a long position, and that is probably why the soybean market has held up a little better.
Right. But today we're actually pushing to some new lows for the move or new lows for the year. And we're kind of flirting with that 200-day moving average. We took out the 100-day and closed below it, I think, yesterday already, didn't we?
We did, yeah. I mean, we're seeing some pressure come into the soybean market. And, I think weather forecast out of South America is causing a lot of this is, they're supposed to see some drying out in Brazil. That's going to get the harvest rolling. It'll get the safrinha corn planting, the planters rolling again. So I think that's a little bit negative. It'll be able to allow some shipments to take place out of Brazil for soybeans. So I think that's causing a lot of the sell-off. I would expect, seasonally, we do see the grain slip this time of year. And I think we're going to continue to see that until we get closer to the acreage report at the end of the month.
And lower soybeans and wheat weighing on the corn, despite the fact that we had some more China corn business this morning.
Exactly. I mean, China continues to come in and buy. That shows their concern about what's going on with the safrinha crop, how late it's getting planted. So we did see another 178. I think that brings us to about 2.4 million metric ton in 6 out of the last 7 trading days. So we've had some pretty good sales of corn to China that haven't really been reflected in the market.
Right. That's about 95.5 million bushels for those that can't get their head wrapped around the metric ton conversion. Wheat market back to new lows here. How much lower do you think we're going to go there, Randy? Where do we find support now?
Boy, I was hoping that these lows would hold, and hopefully today we can see them bounce off of that again. But we're talking about some possible rains in the southern plains, which will help the winter wheat. The crop did show a slight improvement last week, but we continue to see problems up here in the northern plains. We picked up another 6 inches of snow on Tuesday, and it doesn't look like we're going to see any warm up anytime soon. So it's going to impact the planting decisions up here in the northern plains.
And of course, that market not respecting the low crop ratings, the 15-year lows in the stocks. And so it's been pretty frustrating, hasn't it?
It has been. You're right. I mean, you're looking at stocks at 15-year lows. You'd expect to see a little bit of push in this market, but we continue to see the war premium get eroded. We continue to see weather premiums eroded. It's kind of surprising to see that in wheat. Hopefully we can get a little bit of demand going forward here, but with the extension of the Black Sea Grain Initiative, it's going to be tough to get into that export market until maybe midsummer.
Yeah, we certainly do have a hangover from that deal being announced or extended. Cattle and hogs, both in the same shape. We really can't bottom those markets till we get rid of this risk off and macroeconomic, depression that we're seeing here spill over into the meat sector, right?
I think you're right. I mean, right now the economy is what drives our meat consumption. 70% of our red meat goes to restaurants. So right now with a little bit of concerns in the economy and disposable income possibly decreasing because of higher interest rates, that's been causing the problem in the meat sector. And even though we got tight supplies as far as the cattle are concerned, you still need to have a out with it or some demand, and that is starting to be a concern.
Yeah, and hog supply is actually the opposite situation. We're seeing numbers over a year ago. So really, we can't get that market bottomed here either. All right, well, watch to see what the Fed does today. That'll be key here for the meat market. Thanks so much for joining us, Randy Martinson, Martinson Ag, and that is Markets Now.